Today, we're going to try something fun. We are going to step into the shoes of a legendary investor, and we're going to take a hard look at a company we all know, Nestlé. We'll use a classic value investing framework to see if this global giant is actually a smart buy right now, based on the real numbers.
So, this is the big question, right? The one that's going to guide our whole investigation today. Would someone like Warren Buffett, a legend in the investing world, actually pull the trigger and buy Nestlé stock today? Let's find out.
To get our answer, we've got a game plan. It's a simple 4-point checklist. First, we'll check the quality of the business itself. Then, we'll look at its financial health. After that, we check the price. And finally, we'll tally up a final score. Simple, structured, and it gets right to the point. Okay, first up, the business quality check. In other words, is Nestlé what Buffett would call a wonderful business? You know, one that's just consistently incredibly profitable. Time to dig into the numbers. A really key metric here is something called return on equity, or ROE. Basically, it shows how much profit a company squeezes out for every single dollar that shareholders have invested. It's kind of like a report card for how well the management is using your money. And what we're looking for here are high, steady numbers. And here we go. Nestlé's ROE is an impressive 27.53%. Now, to give you some perspective, a lot of value investors think anything consistently over 15 or 20% is the sign of a really fantastic, high-quality business. So this is a great start.
All right, next is the return on invested capital, or ROIC. Now, this metric is a little bit broader than ROE because it also includes debt in the calculation. It's looking at the return on all the money the company uses to run its operations. Nestlé's ROIC comes in at 11.07%, which, again, is a solid, respectable number.
So when you look at these core profitability numbers together, it's pretty clear that Nestlé really knows how to turn capital into profit. So for business quality, it gets a big, definitive checkmark. It passes. Okay, on to part 2, financial health. You know, even a fantastic business can be a super risky investment if its finances are shaky. So let's take a peek at Nestlé's balance sheet, and we're going to focus specifically on its debt. This number right here, 1.76, is Nestlé's debt-to-equity ratio. It's a pretty straightforward comparison of how much the company has borrowed versus how much its shareholders have actually invested. It's a key way to measure financial leverage. Now, for a little context, a ratio under 1 usually means a company is on pretty solid ground, funding itself more with its own money than with borrowed cash. Once you get over 2, you start to see some higher risk. Nestlé's 1.76, it's kind of in that middle zone. It shows a pretty significant reliance on debt, which for a stable company like this isn't a screaming red flag, but a cautious investor, they would definitely make a note of this. Now let's look at how Nestlé treats its shareholders. That dividend yield of over 4% is definitely attractive. But that last number, the payout ratio, that one's a real eye-opener. At almost 87%, Nestlé's paying out nearly 87 cents of every single dollar it earns in profits back to shareholders as dividends. That is very, very high, and it leaves very little money left over for reinvesting in the business or handling any unexpected bumps in the road. It's for sure a point of caution.
And this brings us to part 3, which is maybe the most important part of our whole checklist, the price. I mean, you can find the best company on the planet, but if you overpay for it, it's still a bad investment. So, is Nestlé actually selling at a fair price?
Our first clue is the price-to-earnings ratio, or PE, which is sitting at 21.35. All this means is that investors are willing to pay over $21 for every $1 of Nestlé's annual earnings. But you know, a number like this is pretty meaningless without some context. And here is that context. If you compare it to its own 3- and 5-year averages, Nestlé stock is actually trading at a slight discount. Now, this suggests the price isn't totally crazy expensive right now, at least compared to its own recent history. But that's still only part of the story.
To really know if the price is right, we have to talk about the margin of safety. This is an absolute cornerstone of value investing. Think of it as a safety net, a buffer between what you think a business is truly worth, its intrinsic value, and the price you're actually paying for it. A big margin of safety is what protects you if you're wrong or if the company just has some bad luck.
So, the big question, what is Nestlé's margin of safety? Well, according to a discounted cash flow analysis, it's negative 1.67%. And this right here is the most crucial finding of our entire price check. It means the current stock price is actually a little bit higher than its calculated fair value.
For a true value investor, this is almost always a deal breaker.
Okay, so we've checked the business quality, we've looked at the financial health, and we've analyzed the price. Now it's time to put it all together and look at the final scorecard.
This slide really sums it all up nicely. The business quality, it's excellent. Green light, no doubt about it. Financial health, well, that gets a yellow light for caution, mostly because of that debt level and the super high dividend payout. And then the valuation, that gets an unfavorable verdict, a red light. That negative margin of safety is a really major hurdle for a classic value investor.
And this all brings us to a classic Buffett quote. Nestlé is, without a doubt, a wonderful company. But our analysis suggests it's trading at best, a fair price, and maybe even a slightly unfair one. So here's the dilemma. You're not getting that wonderful company at a wonderful price.
And that really leaves us with one final crucial question. Our analysis shows a fantastic, stable business that just isn't on sale right now. So every investor has to ask themselves this. For a company this strong and this reliable, how much of a premium are you really willing to pay? Something to think about. Thanks for joining me.